They just tried to kill this rally. And it didn't die. If you've been around silver long enough, you know there's one move that ends the party. Not a tweet, not a CPI print, not some random analyst downgrade. The move comes from the rulebook. 3 letters that matter more than any headline when the market gets too excited: the CME. For decades, the silver market has lived under the same threat: if it runs too hard, they'll change the rules, raise margins, jack up the cost to hold a contract, force the leveraged crowd to cough up cash overnight. And when they can't, they dump positions, the chart collapses, and everyone goes back to saying silver is uninvestable. You've seen versions of this movie before. The mechanism is simple. You don't have to beat the metal, just break the people holding paper. That's why what happened next should bother you. Because the exchange reached for the nuclear option. Not a gentle tap, a real hit, a margin hike designed to shock the system and engineer a sell-off. The kind of move that normally turns a breakout into a funeral and resets the narrative in one trading session. But instead of folding, the market flinched, and then stood back up. Not days later, not after some polite consolidation. It dipped, found a bid immediately, and ripped higher like the rule change didn't matter. That is not retail hype. That is not weak hands getting shaken out and leaving. That's a fingerprint, a tell, a sign that the buyer underneath this move isn't the kind of buyer a margin hike is built to intimidate. And once you see that, the story stops being about price. Because a margin hike only works if it hits the core buyer, if the buyer is levered, fragile, and forced to sell. When it fails, one of 2 things is true. Either the buyer has cash, or the buyer has a motive that's bigger than price. So here's the question that should keep you in this video. Who keeps buying when the system changes the rules specifically to make buying hurt? Because if this is a regime shift, if intimidation doesn't stop the move anymore, then the next tool they reach for won't be psychological. It'll be about survival. They reached for the nuclear option, and it didn't land. If you've watched silver for any length of time, you already know the script. The rally starts to breathe. The headlines get loud. And then, right on cue, the exchange hikes margin. Not a small tweak. A real hit. The kind of rule change that usually turns a breakout into a funeral. Because margin hikes don't attack the metal. They attack the people holding paper. They force leveraged traders to cough up more cash overnight. And when they can't, they liquidate fast. That liquidation becomes the avalanche that resets the chart and restores order. That's the old world. Now watch what just happened. The margin hike hits. The market flinches, barely, and then it snaps back like nothing happened. Not days later, not after a long consolidation. It dips, catches a bid, and rips higher. That's not normal. That's not retail optimism. That's not the usual weak hands getting shaken out and walking away. That is the market telling you something uncomfortable. The people buying here aren't playing the same game the margin hike is designed to police. Because a margin hike only works if it hits the core buyer. It only works if the buyer is levered, fragile, and forced to sell. When it fails, one of 2 things is true. Either the buyer has cash, or the buyer has a motive that's bigger than price. And that's where this gets interesting. If the exchange can raise the cost of holding paper and the rally still refuses to die, what exactly is on the other side of that trade? Who keeps buying into a rule change that historically ends bull runs? That question matters more than the price print. Because if this really is a regime shift, if intimidation no longer stops the move, then the next tool they use won't be about psychology. It'll be about survival. They reached for the nuclear option, and it didn't land. And that's the part most people miss. When a margin hike fails, it isn't just bullish. It's diagnostic. It's the market handing you a fingerprint. Because margin hikes don't attack silver itself. They attack whoever is holding silver on borrowed money. They're designed to flush out the exact type of buyer that usually powers the late-stage move. Leveraged momentum. So the moment price dips and then snaps right back, the story shifts. Not to, how high can it go? But to a far more dangerous question. Who was still buying when the trapdoor opened? Who looks at a margin hike, an event that historically ends rallies, and says, "Fine, I'll take more"? Retail doesn't do that. Retail panics. Retail sells. Retail gets margin called and disappears. The usual crowd that lives on leverage sees a margin hike like a surprise tax. You either wire more money or you're forced out at the worst possible moment. But the rebound we just saw didn't behave like fear. It behaved like a bid that was already waiting, quiet, patient, and well-funded. The kind of bid that doesn't care what the margin requirement is because it isn't borrowing to stay in the trade. That's cash. That's size. That's someone who can absorb volatility instead of being destroyed by it. And here's the sharper edge. It's not just cash, it's motive. A paper trader buys price. A physical buyer buys availability. They don't need the chart to look safe. They need metal when everyone else can't get it. That's why buying into a margin hike is such a tell. It suggests the buyer isn't chasing a candle. He's securing supply. Industrial users, deep-pocketed wholesalers, participants who think in tons, not ticks, who can take delivery and remove inventory from the system. If that's what's happening, then this rally isn't just a chart move. It's physical demand leaning on a paper structure. And when physical pressure rises, shorts stop being strategic. They become people trying to exit a burning building before the doors narrow. So yes, if the bounce was real, and if the buyer underneath it is cash plus physical motive, then the control story changes. But here's the trap. The moment a market starts acting like it's coated in Teflon, nothing sticks. Every attack slides off. It becomes a magnet. Not just for believers, for predators. Because unstoppable is a scent, and hot money can smell it from a mile away. The rally shrugs off a margin hike and the message spreads fast. This thing won't die. That's when momentum chasers show up. Fast accounts, leveraged tourists, the crowd that doesn't care about silver. Only velocity. They see a dip and they slam calls. They see a breakout and they stack futures. Open interest rebuilds, not because the system is healthier, but because more paper has piled onto a move that already made the gatekeepers nervous.
We're showing a slight delay
and that's
on the
where
manifest
volatility
here.
turns
That
from
could impact
feature
the entire
into
supply
weapon.
chain flow.
When leverage creeps back in, fragility returns. The market becomes easy to shock. You get drops that feel terminal, candles that scream, "It's over," followed by reversals so violent they leave both bulls and bears staring at their screens like they just got pickpocketed. That's not random. That's how a stressed system defends itself. It can't stop the trend. So it tries to break the people riding it. Exhaustion becomes the objective. So don't mistake the first failed counterattack for surrender. If anything, it's the opposite. When the classic tool doesn't work, you should expect escalation. Another margin hike at a worse moment. Tighter restrictions, sudden rule tweaks, liquidation only, whispers. Anything that can manufacture fear without admitting there's a supply problem. The goal is psychological. Make you doubt your thesis. Make you exit. Make you hand over position to stronger hands at a discount. Here's the uncomfortable truth. Control slipping and chaos exploding can be the same story. Physical pressure can be real and the path to resolution can be brutal. And that's why the next question isn't, how high can silver go? The next question is, what happens when the volatility itself becomes the trap? And who's still standing after it spring loads? After the volatility, boss fight. Most people go back to the same addiction, the candle. They stare at the chart like it's the whole story, up, down, headlines, buys. But if this is really a control problem, the chart is just the smoke. The fire is deeper. So the script does something smart right here.
We can't afford
it
any more delays on these
price
shipments.
and starts talking about plumbing.
I'm prioritizing the urgent ones, but
Because
it will
the
take
real
time
tell
to review
isn't
all
what
this.
silver costs. It's how traders behave when delivery gets close. In a normal futures market, there's a routine dance. As the front month approaches delivery, most participants roll forward. They sell the near-month contract and buy a later month. Why? Because they don't want metal. They want exposure. Rolling forward is the system's way of saying, we're here for paper, not pallets. Now imagine that rhythm flips. Instead of rolling forward, positions start moving backward, from later months into the near month. That's not a technical quirk. That's a decision. And the decision says, I don't want March. I want now. The narrator frames it through exchange data. Contracts draining from a future month while the immediate delivery window swells. It's like watching a crowd leave the line for next month's shipment and pay extra to cut into the line at the front. Here's the simplest analogy: iPhone launch day. You can pre-order and wait for the March delivery. Sure, but if you start hearing rumors that the March shipment is going to be late, or short, you don't calmly wait in the pre-order queue. You pay a premium for the "in-store today" ticket. You jump the line because time suddenly matters more than price. And that is the point. Backward rolling isn't speculation about a higher chart tomorrow. It's anxiety about availability tomorrow. It's institutions behaving like delivery is a variable, not a guarantee. In a healthy system,